Hello everyone, I'm Salvador, tax principal and country leader for indirect tax services at KPMG in the Philippines. It's been a while since we last had an episode, so I want to welcome all of you to KPMG PH Insights, where we dissect and discuss significant tax matters that impact you or your organization. Now, if you recall, earlier this year, a number of our KPMG tax partners provided insights on the ease of paying taxes law. And thank you to all of you who watched these episodes, asked questions, and reached out to us for guidance. Now, for the next few episodes, we'd like to focus on another new law. This time, we'll focus on Republic Act 12023, also known as the Digital Services Tax Law. This law took effect on October 18, 2024, and it amends the tax code by expressly subjecting digital services provided not only by Philippine companies but by non-residents to value-added tax. Now, to provide insight and clarity, joining me is Robediso. He is one of our tax partners and country leaders for global compliance management and tax reimagined. Hello, LA. Great to have you here.
Hi, Manny. I'm glad to be back. I've been monitoring this law since 2022 and was part of the technical working group of the Senate's Ways and Means Committee. So I'm so excited to share what I've learned.
And I'm excited for learning what you have to share. So let's dive in, shall we? Can you give our audience an overview of what this law entails and its implication for business operating in the digital space?
Sure, Manny. Let's start with the basics law. The law makes it clear that digital services are now expressly subject to VAT. This applies to services consumed in the Philippines, whether provided by local companies or non-resident digital service providers or DSPs. So this actually deviates from the CITES rules we're familiar with, where services only fall within the coverage of Philippine tax laws if the services are physically or literally performed within the Philippines. The Digital Services Tax Law aims to create a level playing field for local and foreign or resident and non-resident service providers. It essentially expands the VAT base to include digital services provided by both Philippine residents and non-residents. This means that non-resident service providers engaging in these activities in the Philippine market will now have to register for VAT and comply with local tax regulations.
That's right, LA. And it's quite a change, because I noticed that for purposes of this law, it seems that the applicability of VAT on digital services is no longer determined by place of performance as it was before, but it would seem now it is determined by place of consumption. So that alone may already be considered a huge change in our VAT rules. So, how do we define digital services under this law?
The term digital service refers to any service supplied over the internet or through an electronic network that is essentially automated. This includes things like online search engines, e-marketplaces, cloud services, online media and advertising, and even digital goods.
One of the questions that are top of mind of non-resident DSPs is what are their obligations under the law? I understand that this would vary depending on whether the customer is a Philippine VAT registered or not. Is that true?
You're right, Manny. Non-resident DSPs are now responsible for assessing, collecting, and remitting the VAT on the digital service they provide in the Philippines. But this obligation only applies to the transactions where the customer is not VAT registered. If their customers are VAT registered, those customers will need to withhold VAT on the services. These VAT-registered non-resident DSPs will also not be able to avail of any input tax credits. A non-resident DSP will only be liable to assess, collect, and remit VAT if it becomes VAT-registered and its customer is not VAT-registered. In cases where 1. Both the non-resident DSP and customer are VAT-registered, 2. The non-resident DSP is not VAT-registered, but the customer is VAT-registered, or 3. Both the non-resident DSP and customer are not VAT registered, it is the customer which has the obligation to withhold and remit the VAT. However, in the third situation, I think it would be very challenging to compel individuals to withhold and remit the VAT. Thus, the IRR should be clear on the obligations of not only the non-resident DSPs, but also their VAT and non-VAT registered customers.
I completely agree, LA. I can't imagine a scenario where the BIR will have to compel individual consumers to file monthly withholding VAT returns. That would be chaotic. Now that said, I think the IRR should also clarify the obligations of non-resident DSPs operating as online marketplaces. As you know, Christmas is just around the corner, and transactions which go through these online marketplaces, in my mind, would be most affected by this law, don't you think?
Glad you brought that up, Manny. Under this law, online marketplaces will be liable for remitting VAT on transactions from non-resident sellers using their platform, particularly if 1. They control key aspects of those transactions, and 2. The non-resident DSP performs any of the following. A. Sets, directly or indirectly, any of the terms and conditions under which the supply of goods is made, or B. The non-resident DSP is involved in the ordering or delivery of the goods directly or indirectly.
I noticed that the law uses the term key aspects of control, but it seems to be not very well defined. I think it needs to be clarified by the IRR, don't you think?
I agree, Manny. Filipinos became more accustomed to using online marketplaces since the pandemic, so we should know if this law would affect in any way our overall shopping experience.
Now let's talk about another important point, which are the invoicing requirements for these DSPs. Now, being part of the global indirect tax services network, I find out that invoicing is actually one of the pain points of other countries when they implemented their own digital services tax law. Some of the common concerns from other countries would relate to the format of the invoice, the manner of issuing the invoice, collection of information, for example, the VAT ID. Pricing is another example, whether or not the amount of VAT should be displayed outright, or whether it is sufficient to just state the price, whether it's inclusive or inclusive of VAT. Now, so these are a number of issues. Now, for our own digital services tax law, what should a non-resident DSP be aware of?
So under our law, VAT-registered non-resident DSPs must issue a digital sales invoice that include essential details: the date of the transaction, a transaction reference number, identification of the consumer, a brief description of the transaction, and the total amount indicating that it includes the VAT. If applicable, they also need to break down the sales price and the VAT calculation.
LA, one thing I also noticed while discussing is that you keep on mentioning the phrase VAT registered non-resident DSP. Does that mean that all non-resident DSPs will be required to register with the BIR?
So the law aims to implement the same threshold, no, for residents and non-residents. So if the non-resident DSP's gross sales exceed 3 million, they'll need to register for VAT with the BIR. The BIR plans to establish a simplified automated registration system to facilitate this process. Now, the problem lies on how the 3 million threshold will be computed or determined. Will these comprise only of sales to non-VAT registered customers or B2C sales? Or will the BIR still include the sales made to VAT registered customers or the B2B sales, even if withholding VAT already applies on the latter case?
Those are very good questions, LA, and I think it's another matter that should be addressed by the implementing rules and regulations. Because, of course, non-resident DSPs are very wary of submitting to the jurisdiction of a taxing authority. So, what happens if a non-resident DSP reaches a 3 million threshold and fails to register?
Okay. The law actually has strong enforcement mechanisms, no? Because it gives the Commissioner of Internal Revenue the authority to block the digital services of a non-compliant provider with support from the DICT or the Department of Information and Communications Technology through the NTC or the National Telecommunications Commission. Essentially, they can prevent Filipino customers from accessing the digital services by blocking websites, platforms, etc.
That brings up a very good point. You sort of wonder how our own government plans on monitoring compliance. Just to share a lot of the discussions that we've had in the Global Indirect Tax Services Network, I can cite a number of examples from different countries on the way they try to monitor. So a good example would be in Australia. They apparently monitor compliance by getting data from anti-money laundering regulators. That's one. No? In Europe, no, I don't know what particular country, the tax authorities get data from payment service providers. In Chile, another good example, they require banks to provide details on the volume of transactions. Other jurisdictions simply request digital service providers and wait for them to respond. So they're a bit kinder. In some other jurisdictions, they resort to blocking access to digital services, which is a bit more draconian if you think about it. And in some cases, even criminal penalties may be imposed on foreign executives of non-compliant DSP. So it remains to be seen if the BIR is going to adopt any of this. Other common causes for non-compliance would include lack of information, or where most tech companies are startups, they're not willing to pay a lot of tax, rather a lot for a tax advisor. Now, on a separate note, do you think all digital services are covered by this law?
Well, not all will be covered by the digital services law. So there are certain items that will be exempt, no? Most especially the digital educational services would remain exempt from VAT, no? But only if they are provided by accredited educational institutions. Additionally, services through digital platforms by banks and certain non-bank financial intermediaries are also VAT exempt.
What can you say about the allocation of the VAT collected, LA?
Well, 5% of the incremental revenue from the VAT on DSPs will be allocated exclusively for the development of creative industries for 5 years. After that period, the revenues will go to the general fund. This provision of the law was one of the last-minute additions at the bicameral conference committee level. Well, this is a good initiative on the part of the legislators, but I really hope that the drafters of the IRR will also keep this objective in mind.
On to another important point regarding the timeline for implementation. What do you think our audience should keep in mind?
First, the transitory provision provides that non-resident DSPs will be subject to VAT 120 days from the effectivity of the IRR. Again, it's from the effectivity of the IRR. The IRR will be issued not later than 90 days from the effectivity of the law, which was on October 18, 2024. So take note of the language used. The IRR will be issued not later than 90 days, which means that the DOF and the BIR may not maximize the whole 90 days to come out with the IRR. No? I remember during the Senate hearing that they were really wanting to have a shorter period of implementation. No? That's why I don't think they might use the entire 90 days. So non-resident DSPs more or less have 6 to 7 months to prepare for this law, and KPMG is here to assist in providing clarity even before the IRR goes live.
That's right, LA. It's crucial for businesses to understand these changes as they will significantly impact operations. And we're here to guide everyone through this transition and ensure compliance. Thank you for joining us today on KPMG PH Insights. We'll continue discussing the Digital Services Tax Law once the IRRs are issued, so you stay tuned.